A quick introduction about myself then. My name's Nadia. I'm not sure if I've had any of you in my session before, but I do teach P1 for CIMA. I teach BA2 sometimes, so base level paper for CIMA as well. I also teach performance management when it comes down to ACCA and a lot of different papers to do with strategy and tax. So I've been teaching for quite a number of years now. So as far as CIMA is concerned, BA2, P1 are the ones that I usually focus on, and then the case study papers. Now, the important thing about variances is you're going to see variances as objective type questions in your P1. But when you go on to your case study, which is your operational case study, the very first case study you will see in CIMA, you will see them being examined as actual written questions. So it's important to get that foundation right. So if you're doing P1, make sure that you focus on variances. Do remember performers, because those would be useful when you move on to your case study paper. What are we going to be looking at in this session? We're mainly going to focus on what it is that you would need to do when it comes down to questions in your exam. So more exam focused, but taking you through the basic variances and also in a little bit into the advanced variances as well. Okay, I've got to be mindful of time. We've got 45 minutes with each other today. So I do want to keep it as interactive as possible. So if you've got any questions at any time we're discussing, please do ask. If you are asked a question, even if you're not sure on the answer, I'd rather you attempt, have a go at it, because there are no marks for getting it right or getting it wrong here. In class, we're here to learn. So I want to make sure that you're all interactive and actually taking part in the session so we all benefit from the 45-minute session, right? So in today's session, I'm going to look at basic variances, what they mean, how they work. I'm going to give you a step-by-step method, since some of you said logic around the steps to follow when it comes down to questions. We're going to have a look at that as well. And we are going to do a question. In fact, I've got 3 questions in all 3 areas. So we're going to start with the basic variances. From the basic variance, I'm going to discuss about mix and quantity, then getting into planning and operational. So I would try and do as much as possible in this session, right? So let's start then. Step number 1 is always going to be to begin with a flexed budget. What do we mean by a flexed budget? Is anyone able to tell me what do we mean by flexing a budget? Brilliant, Beth. Adjusting an original budget to actual sales volume. We've got Olivia who says the same, depending on true sales. Yeah, because the reason we are flexing a budget, or the reason we are doing a variance analysis, is we've prepared a budget at the start of the year, which we've used to plan. It's used to control how we undertake production or sales or costs, etc. during the year. And at the end of the year, we want to see, right, did we stick to the original budget as we planned, or have we gone way off course? Right? So imagine yourselves, you've been given about £10,000 to go on a holiday. You're sitting at this maybe a month before you plan. You're sitting with the £10,000. You want to put them into different lots and say, right, this is what I'm going to use for my airfare. This is what I'm going to use for my hotel. This is what I'm going to use for probably sightseeing and different activities. This is what I need for my food, and so on and so forth. You keep aside, you put them all into little envelopes, and you go on holiday. When you come back on, hopefully, as you're spending, you're actually making a note of what your expenditure is throughout your holiday. When you come back, after you've recovered, you'd probably sit down and you'd say, right, where did we spend? Did we manage to utilize that 10,000? Did we spend less, or did we spend more? Did we have to go and withdraw some more cash in order to spend in the holiday? What went right? what did not go well. And that is why we do variance analysis. So starting with flexing the budget. Right? So flex budget is where you take your actual units into your budgeted standard cost per unit. Now, budgeted standard cost per unit is always given to you in the exam. You should be able to find out what it is that you're using. This then is compared with actual. Now, the reason we do this is the original budget would have been planned for 10,000 units, but the actual production would be for 12,000 units. So we cannot compare the cost of 10,000 units with 12,000 units to decide whether we've done well or we haven't done so well. Okay, therefore we've got a good comparison is always with like for like, and therefore we compare a flexed budget with the actual budget. Once you've done that, right, you're going to start comparing each line on your profit and loss account. So you'll start with your sales revenue and it'll say, right, how much did we plan initially expect to earn? How much did we earn? Did we earn less? Did we earn more? Right? If we earned more, we'd be really happy about it. And what do we want to do? We want to make sure that we follow that into the future. And that's where we start to break down the variances. So what you see here, flexed versus your actual, is what we call as a total variance. Right? So the should do and did do method is the easiest way to work through your total variances. Starting with what should have happened if we had actually produced the actual amount of goods or sold the actual amount. And if our cost figures were right, what would our expenses or earnings have been versus what we actually did earn? Did happen always is straightforward. It's from your question. You don't have to struggle too much to decide how much you spent. So you don't have a working day usually when it comes down to did or didn't do. Right? So again, emphasis on the should, because this is where your calculation comes in, and it's important to get the should part of it right in order to get your answer right. And so what do you start with? You always start with your actual production units. At some places, you'll see that you use actual number of hours. So when we go into variances, we'll see where we change from units to hours. So actual units produce into either the standard kgs if it is to do with material, into standard labor hours if it's got to do with labor, right? And then you multiply it with a cost per unit or the standard price per unit. So most of the information is given to you in the question. All you've got to remember is your starting point, which is the actual production units into your standard quantity per unit, into your standard price per unit. Right? Does anyone have any questions right up till here? Right, did, in case you ever have a working for the did part of it, it's going to be your actual production units. So that stays the same, but this time it's going to be the actual quantity that we've used, whether it's in kgs or hours, into the actual price that we've paid per kg or per hour of the unit produced. Right, so this is what we're comparing when we say should do and did do. Once you're comparing that, the numbers are easy, but what we want to sit back and think is, right, did we spend more or did we spend less? I like to remember things as, is it good or is it bad? Now let's take earnings from sales. We had budgeted to earn 10,000, but we earned 12,000. Is that a good thing or a bad thing? What do you think? You initially assumed that you, or estimated that you will earn 10,000 at the end of the year, but you've actually ended up earning 12,000. Is that a good thing or is that a bad thing? Bet says good. What about the rest of you? Mary agrees. Yeah, good. Brilliant. Yeah, it's good. And in technical terms, the word good, we will always use the word favorable or the letter F. Now, if I told you on that holiday you planned to spend 10,000, but you actually ended up spending 15,000 on all expenditure, is that a good thing or a bad thing? Brilliant. If you spend more than you had predicted to spend, then it is an adverse variance. Right? So I'm going to move away from this screen and we're going to have a look at this concept, the basic concept, using a question. I'm going to flip screens and very shortly you'll see my screen being shared and we're going to work through this together. I'm just going to make small adjustments so you can still see me and have the document on screen. Right, so what do we have here? We've got a standard cost card where we've been told direct material being used per unit. We're going to use 4 kgs per unit, and each unit should cost us $4.50 per kg. Direct labor hours, we use 5 hours per unit that we produce, and each hour we pay $5. Variable overheads again are based on those 5 hours, but this time we pay $2 per hour, and we've been given our variable cost of production of 53. We've been told our fixed budgeted overheads or fixed overheads are 130,500. We've also been given our selling price of 75. Budgeted production was meant to be 8,700, of which they said that they're likely to sell 8,000 units. So they will produce 8,700, of which they plan that they should get rid of at least 8,000 in the form of sales. But the following information then is available for the month of June, where you're given the actuals. Sales were 8,400 units. So the moment you see your actual units, and you've also been told your actual production and the cost given to you, right? What is step 1 always going to be? Step 1 will always be to flex the budget. Right? And we said flexing a budget is always going to be your actual units into the number of kgs or hours, that's your standard, into this cost per kg or per hour. Right? Now think about the cost very carefully. Are you going to flex the cost of material, labor, and overheads using the number of units sold or the units produced? What should you do? What would you use? Are you going to use 8,400 or are you going to use 8,900? Brilliant. Your flex will always be based on the units produced, because that is what we have spent. Okay. When we do our sales, we will think about how much did we sell and how much should we have sold. Okay. But when it comes down to the cost, it's always the cost of production. Therefore, the units that you will consider is 8,900. On the following page, I've done the basic variances because that's the total variances are a lot easier than everything else. So here, what do we have? We've got our units sold, our original. Now our flexed versus our actual is what we're going to use for our variance. How do we get these numbers? This would have been based on 8,700. This is based on 8,000. Sorry, this would be 8,000. and 8,400 because it is sales. Whereas here this is based on production. Right, so 8,700, 8,900. We don't care about the originals because we're always going to compare the flex versus our actual figure. Let's take material for example. 8,900 units. Each unit is $18. So here, how you're going to flex that is 8,900 into $18. Your actual will always be from the question. Okay, unless given specifically to work out, your actuals is always given to you in your question. So starting with the sales figure, we had planned, according to our budget, we should have earned 630,000, but we only earned 613,200. What did we do? We earned less than we had planned, which is bad. And bad in technical terms means adverse. How do you work out the difference? The difference is always between flexed and your actual. So flex minus actual will give you your number. We don't want to stop there. We want to know, why do we have this adverse variance? What went wrong? Was it because something went wrong with the price? Now we know we've sold more than we planned. So it's not the quantity variance because we initially planned to sell only 8,700, but we've sold 8,900. So we've sold more, which then means in order to sell more, what have we done? Yeah, we've offered a discount, which hasn't worked for the company because in the total variance has turned out to be an adverse variance. So for each total variance here, we want to dig deep and see what went wrong. Was it the kgs? Or was it the dollars? So here, kgs is your usage, dollars is your price. Think about the next one, labor. Again, is that ours or is that our dollars? Where have we gone wrong? Because there are always two elements to your working. kgs, dollars. Right? One of them hasn't worked out. So here your R's becomes your efficiency, your dollars become your rate variance. Right? Looking at the time and looking at the fact that you find sales mix and operational variances more difficult, I'm going to have a work through a few of these variances. The remainder, it's a good additional question for you to practice. So I'd say have a go at this in your own time. So starting with your sales price variance. Right? Should method. If we have sold 8,400 units, and each of it sold at $75. Now again, this 75 is from the question. That is my selling price. Right? At $75 would mean that I should have earned 630. What did I earn? In the question given to me, we earned only 613,200. $613,200. The difference between them is 16,800. We earned less, therefore it's an adverse variance. Right? Let's think about our volume variance then. We should have sold 8,000 according to our budget. Should is always budget. Did is always actual. Right? What did we sell? We've sold 8,400. We've sold more, therefore it's a good thing. And that's why I've got a favorable variance. How good are we? We've sold 400 units more. We don't stop here because we always talk money, and we must convert any variance that's not in dollars into the dollars. Right? Whenever you're doing a volume variance, you could either use your profit figure or your contribution figure. When you're expected to use the profit figure, they would have given you your fixed overhead absorption rate per unit. If you have a look at this question, they've given you a total fixed overhead. They haven't given you a fixed overhead per unit, which means you're going to go with contribution. Can you tell me what is the formula for contribution? How do you work out your contribution per unit? Brilliant. Your selling price minus your variable cost. Yeah. Selling price was $75. Variable cost is $53, which leaves us with $22 as a contribution. Okay, so to convert the $400 units into a variance in dollars, we're going to multiply that with a standard contribution as per our working, which was 22. That gives us variance in dollars. 8,800 favorable. Right? So it looks like we've discounted, we've sold more, but we've had to reduce our selling price to below 75, and that's what's given us an adverse variance. Let's have a look at another one, which is material variance. If you have a look here, we've got a total variance of 3,255 adverse. And we want to know why is that adverse. So is it because of our usage or is it because of the price? So let's keep that here. 3,255 adverse. Right? Starting with the material price variance. When you think about the price, are you going to think about the number of units you have produced, or when you went to the shop, how many kgs you purchased? How do you decide your price variance? Do you think about the units, or do you think about how much did you buy and how much did you spend? Brilliant, Beth. We need to know how many kgs we purchase. So actual kgs. And if we have a look at the question here, it tells us that our material costed us 163,455 for 35,464 kgs. So when we're doing our material price variance, we're going to take that 35,464 kgs. Again, going to our should and did method. Should have costed us, if we had predicted it correct, we would have purchased 35,464 and each kg would have costed us $4.50 per kg. Right? So here into $4.50. 50. How much did it cost us? It's given to us in the question, 163,455. Right? So in your calculator, if you put 35,464 into $4.50, how much do you get? Thank you. Right. If we had spent $4.50 for the amount we've purchased, we should have spent $159,588, but we've ended up spending $163. Is that a good thing or a bad thing? Is it good or is it bad? Brilliant. We have spent more than we should have. Therefore, it's an adverse variance. How adverse is it? Put the two numbers in your calculator and you will get the answer. 3867. Brilliant, Beth and Olivia. Right? Okay, so we know we've spent more than $4.50. We've got 3,255 here. Let's think about our usage. Did it actually mean that we've spent more, but we've bought a better quality product? So here we're going to look at our usage. Now, when we think about usage, are we going to think about the number of units or are we going to think about the number of kgs that you've gone out and purchased? Because you want to think about, did we use more or did we use less in our production process? What would you consider? Yeah, because we are looking at usage in production. Did we put more than 4 kgs or did we use less than 4 kgs in order to produce 8,900 units? So our should would be based on our actual production of 8,900 into 4 kgs. Which gives us 35,600. How much did we actually use? This is always going to be as per our question. Whatever we go out and we buy, we assume that we use in our production, which was 35,464. 35,464. Do we have a good thing or a bad thing when it comes down to our usage? Did we use more or did we use less? So is that good or bad? Alina says good. Yeah, absolutely. We've used less than we budgeted, and therefore that's a favorable variance. Thank you, Mary. 136 kgs less. But again, that is variance in kgs, no good to us. So we're going to multiply that by our standard cost. And here we know our standard cost is $4.50. So here multiply that by $4.50. Right? And that gives you your variance in dollars of 612. And that's how you work through your basic variances. You've got your labor variance. Now, if you take your calculator and put these two numbers, 3861 as a negative number and 612 as a positive number, you'll end up with 3,255 as an adverse. Keep in mind your total should always be equal to your price plus your usage variance. Same working will go for labor. If you think about labor rate, you will think about hours paid. When you think about efficiency, again, you'll think about number of units produced into the R's that we should have used per unit. Because here we think about how much did we pay them? Did we pay them more or less per hour? Or here we think about, did they work faster or slower? Right? Watch out. In this question, I've intentionally put this information that they worked 44,100 hours, but we paid them for 45,400 hours. What does that mean that you've got to think about? Brilliant. Okay, so here you'll also have an ideal time variance, which is the difference between the hours worked, paid 45,400, worked only 44,100, which means we've got an adverse variance of 1,300. Again, that's in hours. Hours is no good to us, so you're going to convert that into dollars by multiplying it by the labor cost. Keep in mind, an ideal time variance will always be an adverse variance. You can never have a positive ideal time variance. Right? So I'd like you to have a go at the remainder of this question at home. I will send across a worked out answer script for this, so you can always compare your working to see if you've got this right. Right? Does anyone have any questions on your basic variance, how it always works? Any questions? No? All okay? Okay. Let's move on to the next one. That brings us to our next variance, which is to do with our mix and quantity variance. We see material, we also see it in sales. I found that sales is something that learners usually struggle with, and therefore I've thought about the sales mix and quantity variance rather than the material variances, right? So what do we do in our mix variances? Now think about mix as a recipe, okay? You've gone on to BBC Food, you've picked up a recipe which says you're going to make cupcakes. It tells you how much flour you need, how much of eggs you need, how much of sugar you need. You read the recipe, that is your budget. But when you actually start making your cupcakes, you decide, you know what, I'm going to reduce the amount of sugar and I'm going to change the flour that I use into maybe something more healthier, okay? And you're going to change that recipe. And that is what the sales mix looks at, okay? So it's looking at the recipe and saying, right, if the recipe went well, you would have ended up selling more, okay? Did that work? Did that change in recipe actually work for you or not? Whereas the sales quantity, on the other hand, looks at what is happening with the total amount of units that we have sold. Okay, did we sell more of all the units? Overall, was our sales higher than we expected, or is it lower? Right? Now, the easiest way to think about your mix, yeah, no worries, Marcus. Whatever from here will be recorded. So if you want to have a listen in, you can listen into the recording. Zita, are you okay? I can see you've got your hand raised. Right? Okay. So what are we going to do when it comes to the mix variance? Whenever you see the word sales mix, learn this as a formula. We're always going to keep our quantity constant, okay? But we're going to vary the mix. We're going to say, right, original recipe, what should have been the output? With the actual recipe that I have followed, what should be the output? So sales mix is looking at the output of the items, right? When you see the word quantity variance, you're going to keep your mix. It's always going to be the opposite that you'll vary. So if you see the word mix, you're going to vary the mix. You're going to keep the quantity constant. If you see the word quantity, you know that's what you've got to vary and keep the opposite constant. Okay, so quantity, constant. Using that, I'm going to show you another question, but you'll see it's a lot easier to work through with numbers rather than just simple formulas, right? So I'm going to swap screens again. And this time we're going to look at a sales mix and quantity variance, right? So we've got two products, alpha and beta. The sales budget was to sell 800 units of alpha and 800 units of beta, which means our overall sales should have been 1,600 units. Right? How much did we actually sell? We sold 750 of alpha and 700 of beta, which means we've sold 1,450 units. Okay, and what have we been asked to work out? Total sales mix variance. So if you read the word mix, you know you've got to keep quantity constant and the quantity that we refer to is always the actual quantity. What are we going to do? We're going to vary the mix. So imagine this as a bag, and each bag has some units of alpha, some units of beta. Right? So vary the mix, starting with our quantity. Our actual quantity was 1,450 units, and that is what I'm going to keep constant. Right? I'm always going to work on the should and did method. Should will be the actual quantity into the standard mix. Did will always be as per the question. Right? Let's think about the mix. If you're selling 800 of alpha, 800 of beta, what we usually do is alpha will be 800 by the total 1,600. Beta will also be 800 by 1,600. Here it's pretty simple. It means it's 50-50. So 1,450 into 800 divided by 1,600. This is your standard mix. 1:1. Which means, according to our original recipe, we should have only sold 725 units of A and 725 units of B if our total quantity budgeted to sell was 1,450. That is our flexed budget. How much did we sell? We sold 750 of alpha and 700 of beta. Right? So what do we have? We have sold less, therefore it's adverse. Sorry, we've sold more, it's favorable. We've sold less, it's adverse. Right? Yeah, no worries, Mary. So here, how much? We've sold more. We've sold 25 units more. Here we've sold 25 units less. Again, this is variance in units. No good to us. We must always convert this into dollars. Therefore, you're going to go at standard contribution or profit. Given to me here is standard profit. So I'm going to multiply that with the profit figure. Right? So here 125 favorable, 75 adverse, giving me an overall of 50 favorable. Right, so what did we do? We sold more of the product with a higher profit than the one with the lower profit. So here the overall mix variance worked out in our favor because we ended up earning more than we would have done. Right? So sales mix, keep the quantity constant, vary the mix. On the other hand, you could also be asked the quantity variance. Now, please note, you'll never be asked both of them in one question. They'd be each worth 2 marks, so they will be examined separately. Right, so I've changed the question a little here, and I've said, right, we've got Galaxy who's producing 2 products, Milky and Whey, and the following data was prepared for the month of December. We've been told that the budget was 4,000 units of Milky and 6,000 units of Whey, whereas our actual ended up being 6,000 units and 6,000 units. Now, there is a shortcut method that always works when you do a quantity variance, and therefore I'm going to show you that shortcut method. Right? We've been given the standard profit. So step number 1 is to work out total budgeted profit, which is we had budgeted to sell 4,000 units at $4 each. And we also budgeted 6,000 units at $3 each, which means we had budgeted to earn a total of 34,000 as our profit figure. Right? Step number 2 is to work out the average profit. How do you work out the average profit? It's your budgeted profit divided by the budgeted total units. Budgeted total profit was 34,000. Total units was 10,000. Which means according to our standard mix, we should earn $3.40 in average over the 2 products that we had. Try this method whenever you've got a quantity variance question. You'll always get it right. Okay, so total budgeted profit first, Then work out your average profit. Step number 3 is to work out your variance in in units. We should have sold 10,000. We did sell 12,000. That's a good thing for us. Therefore, it's a favorable variance. How much by? By 2,000. Now, to convert this into a variance in dollars, we're going to multiply it by the average profit. $3.40, which gives you a total of 6,800 favorable. Okay, 3-step method. Work out your total budgeted profit. Use that to calculate the average profit, which is nothing but your total budgeted profit divided by the total budgeted number of units to give you the average budgeted profit for both products, because we're looking at 2 different products here. Work out your variance in units. Use the average profit to convert it into a variance in dollars. Right? Easiest technique. This will always work when you've got a sales quantity profit variance. Even if it's a contribution variance, same method. Instead of profit, you'll work out budgeted contribution. Then you work out the average contribution using the same method. Nothing changes. It's just the wording that changes. Is everybody okay with quantity and mix? Does anyone have any questions? Give me a thumbs up if you're okay. If you've got any questions. I know we're running a little ahead of schedule. So we were meant to finish our session at 1:15. But if you are happy to go on for another few minutes, I'm happy to go over planning and operational variances as well with you. If not, we do plan to have another session sometime soon in the future, and we can bring in planning and operational variances there. Any questions? No, are you happy? No, it'll always be multiple products. You either have 2 to 3 products. You'll never, you won't have it as one single product, because a quantity variance is looking at overall rather than one single product. Okay, are we selling more or less as a total of in quantity, right? If they did ask you for a single product, same method, but instead of doing a budget and total for each, you can do A and B separately. Okay, work through the variance in units, but this time again, you will use average profit to work that out. Right? But most often what you get is a total variance. Okay, are we happy to have a look at operation and planning variances? Yeah, give me a thumbs up if you're all okay to stay back a few minutes longer. Yeah. Okay. Right, I'm going to quickly swap screens then. If anyone has to leave, please feel free to do so. I will send over the recording at the end. Right? Now, planning and operational, if we think about it, we started our plan much before our production started. So we looked at estimates from the past experience. And what we did was we said, right, we're likely to have used so much or likely to have costed us so much. But sometimes there could be an error in our planning itself, which means maybe a junior accountant produced a budget, used the wrong figures. In that case, what do we have to do? We've got to revise those numbers. Okay. Sometimes you also have uncontrollable factors, such as a change in maybe a government tax, maybe minimum wages being brought in. So something that's beyond an individual's control. So it wouldn't be fair at the end of the year for the managers to be held responsible for something that wasn't within their control. And therefore, what we do is we break the variances down further into saying, right, what was not within someone's control, that becomes your planning variance, and something that was within the manager's control, which becomes the operational variances. And that's what we can see. So planning is always thinking about it, what is not controllable. Whereas operational is anything that is controllable by the manager in question and therefore should be held accountable. Right? Watch out for the sales, planning and operational variances, because the examiner uses two different words. He uses the word market size variance and he also uses the word market share variances. So I'm quickly going to switch screens and let's talk about market size. Initially, at the start of the year, we assumed that our market size is going to be that much. But there's a current boom in the economy. There's a lot more money for people to spend, so they're shopping a lot more. And therefore, the market size itself increases. That means there are more customers in the market that are willing to buy that particular product. This increase is not within our control. Okay, and therefore it is a planning variance. On the other hand, we've got a market share variance, where initially we predicted to have an X number of customers. But at the end of the year, the managers have done something well, that our size of that market has increased. Okay, maybe they've offered discounts, maybe they've come up with favorable payment terms, right? So this is something that was controllable. We have been able to bring more customers to buy from us. Whereas here there are more customers that want the product. Right? And that's the difference between market price and market share variances. So they don't tell you planning variance or operational variance. They will tell you the word market size or market share. You've got to remember market size is a planning variance, whereas market share is an operational variance. How does it make a difference? It's all in your working. Planning will always be original versus revised, whereas operational will always be actual versus revised. Right? Let's quickly have a look at a question to do with planning and operational variance, but this time I've taken something to do with labor. Okay, so we're going to have a look at labor variance when it comes down to planning and operational. Right? So standard cost was predicted to be $7 per unit of X. Each unit takes half an hour to produce and each hour is paid at $14, which means for half an hour it is $7. Budgeted production ends up to be 20,000 units. Due to a high demand of skilled labor, the market rate per hour has gone up to $17.50, but the trainee accountant has not reflected in her budget. Right. Is this got to do with something that is within the manager's control, or is it uncontrollable? Who are we talking about? We're talking about the trainee accountant. So it was not the manager's mistake. It was a human error at the planning stage. And therefore you must revise. Right? Then we've also been given our actuals, which is 22,000 units, actual labor hours, 11,400 hours at $15.50. Right, when you're doing your planning variance, you've got to think about the units that you've got to produce. Are you going to take your actual production, or are you going to take your original production at the planning stage? Beth says original. Anyone else? Unless you're given revised units, always use actual. Okay, so as good as flexing at the planning stage. So here what you're going to use is actual units of 22,000. Right? And flex that budget. Our original would have been 22,000. Each unit takes half an hour to produce, and each labor hour is paid at $14 per hour. However, we've got to revise that. 22,000, half an hour per unit, but this time at $17.50 per hour. $22,000 into 0.5 is nothing but 11,000 hours at $14 per hour. That gives you 154,000. 11,000 into $17.50 gives you 192,500. Is this a good thing or is it a bad thing? Our budget spending has increased from 154 to 192,500. Absolutely. Our spending has increased, and therefore it's bad. And it's an adverse variance. 38,500. Now we want to see what we can hold our manager responsible for. So at this point, we are going to take our operational budget. Right? Should would be nothing but our revised. Did will be our actual. Revised versus our actual. 22,000 into 0.5. Let me just check that. Right. So 11,000 into $17.50, which was 192,500, versus what we did. We ended up paying, hold on, operational will be revised again to our actual. Actual hours are 11,400 at $15.50. So here, 11,400 at $17.50 versus 11,400 at $15.50. Okay, so what we do at this stage is again we flex it, but this time not to units, but to the hours. So 11,400 into $17.50 will be $199,500 compared to $176,700. Is this a good thing or a bad thing? According to our revised budget, if we had used 11,400 hours, we should have spent 199,500, but we've only spent 167. Yeah, we've spent less. Therefore, it's a favorable variance. How favorable? That your calculator will tell you. The difference between the two numbers, 22,800. Right? So keep in mind, planning is always original, but where you haven't been given revised units, you will go with the actual units. But when you're working with the operational, you will look at actual hours when it comes down to labor and actual kgs when it comes down to material. All okay? I know that was quite a lot to get through in a 45-minute session, so we've had quite a long session. If you've got any doubts, you can either contact your own tutor or you could contact the support tutor. Just email info@First&Tuition and they should put you in touch with one of the tutors here. Right? I hope you found this session beneficial. I look forward to seeing you sometime in the future. Good luck with your P1, everybody.